Think about something you own that you use a lot. Your phone, your car, your favorite coffee machine. They're not going to last forever, are they? Eventually they'll wear out, become outdated, or you'll just want an upgrade. This gradual loss of value is called depreciation. Depreciation isn't just about things getting old. It's about recognizing that most assets lose value over time. This is true for everything from the comfy couch you're sitting on to the giant machinery used in factories. Understanding this concept is super important for making smart financial decisions, both in your personal life and in the business world. Why? Because knowing how much an asset depreciates helps you budget for its eventual replacement, calculate the real cost of ownership, and make informed decisions about when to sell or upgrade. So, let's dive into the nitty-gritty of depreciation, explore different ways to calculate it, and see how it can help you manage your finances better. In the simplest terms, depreciation is the decrease in the value of an asset over time. This decrease can be due to a number of factors, including wear and tear, age, obsolescence, or even market conditions. Depreciation matters for a few key reasons. First, it allows businesses to write off the cost of an asset over its useful life. This means they can deduct a portion of the asset's cost from their taxes each year, which can result in significant savings. Second, depreciation helps businesses to accurately reflect the value of their assets on their balance sheets. This is important for getting an accurate picture of a business's financial health. But depreciation isn't just for businesses. It's a concept that applies to your personal finances too. Understanding how depreciation affects the value of your possessions, like that car or coffee machine, can help you make smarter decisions about when to replace them. Now, let's talk about recurrence relations. Don't worry, it's not as complicated as it sounds. A recurrence relation is basically a formula that helps us calculate a sequence of values, one after the other, based on a starting value and a rule. Think of it like a financial echo. You shout out your initial investment, and the recurrence relation echoes back how much it's worth each year, factoring in depreciation. We can use recurrence relations to calculate depreciation in different ways, depending on the method we choose. Let's look at a few common depreciation methods and see how recurrence relations come into play. Flat rate depreciation, keeping it simple. Flat rate depreciation, also known as straight line depreciation, is the simplest method to understand. It assumes that the asset loses value at a constant rate over its useful life. Imagine you bought a delivery van for your small business for $30,000, and you expect it to last for 5 years. With flat rate depreciation, you divide the initial cost, $30,000, by the useful life, which is 5 years, to get the annual depreciation expense. In this case, the annual depreciation would be $6,000. This means that every year, the value of your van on your books would decrease by $6,000. After the first year, it would be worth $24,000. After the second year, $18,000, and so on. This method is straightforward and easy to calculate, but it doesn't always reflect the real-world depreciation of assets, as some items lose value faster in the early years. Unit cost depreciation, every click counts. Unit cost depreciation is a method that ties the depreciation expense to the actual usage of the asset. Let's say you have a high-quality photocopier that you expect to make 1 million copies before it needs replacing. You paid $10,000 for it. With unit cost depreciation, you would divide the cost, $10,000, by the total expected copies, 1 million, to find the depreciation cost per copy. In this case, it would be 1 cent per copy. So, if in the first year you make 200,000 copies, your depreciation expense would be $2,000, calculated as 200,000 times 1 cent. This method is particularly useful for assets used in production lines or for services where you can easily track the usage. Reducing balance depreciation. The fast fade. Reducing balance depreciation, also known as diminishing value depreciation, is a method where the asset loses value at a faster rate in the early years of its life, and then slows down. Imagine you have a $20,000 car and you apply a depreciation rate of 20% per year using the reducing balance method. In the first year, the depreciation would be $4,000, which is 20% of $20,000, leaving a carrying value of $16,000. However, in the second year, the 20% depreciation is calculated on the reduced value of $16,000, resulting in $3,200 depreciation. This method is often more realistic for assets that tend to lose value quickly, such as cars or computers. Depreciation and your financial savvy. Understanding depreciation, whether you're running a business or managing your personal finances, is crucial for making sound financial decisions. It helps you plan for the future, knowing when you'll likely need to replace an asset. It also helps you understand the true cost of ownership, factoring in the inevitable depreciation over time.
Till next time, keep wondering, keep learning.
Want to rise to your full potential in your studies and revise like a boss? You can trust Study Guide today to have you covered. Subscribe to this channel and see our website linked in the description of this video to see revision articles to maximize your study gains.